Welcome back to Simple Mind Space, the podcast dedicated to helping you achieve financial freedom and unlock your full potential. Today, we're diving deep into a topic crucial for anyone navigating the world of cryptocurrency: diversification. Now, you might have heard the old saying, don't put all your eggs in one basket. Well, in the often volatile world of crypto, this adage rings truer than ever. Diversifying your crypto portfolio is essentially about spreading your investments across different cryptocurrencies instead of concentrating solely on one. This strategic approach minimizes risk and safeguards your investments. Think of it this way: if one cryptocurrency takes a hit, the others in your portfolio can act as a buffer, potentially mitigating your losses. It's about not having all your hopes riding on a single asset, especially in a market as dynamic and, let's be honest, sometimes unpredictable as crypto. While diversification is a fundamental principle in any investment strategy, it takes on unique characteristics in the crypto space. Let's explore why. If you were to ask seasoned crypto investors, why not go all in on Bitcoin? Many would point you to the performance data. Looking back at the crypto market from January 2018 to March 2024, portfolios solely focused on either Bitcoin or Ethereum showed similar annual returns, hovering around 30%. However, Ethereum, known for its higher volatility, had a lower risk-adjusted performance compared to Bitcoin. Now, when we introduce a portfolio split evenly between Bitcoin and Ethereum, we see a slight increase in risk, but also a notable increase in returns. This translates to a better risk-adjusted performance. The magic truly happens when we analyze a portfolio diversified across the top 10 cryptocurrencies. This strategy consistently demonstrates the best risk-adjusted performance, significantly outperforming portfolios solely reliant on Bitcoin or Ethereum. This historical data, while from a relatively young market, reinforces a principle well established in traditional markets. Solely depending on one asset often leads to subpar returns compared to a diversified portfolio, especially when we factor in risk. Let's delve into the intricacies of risk management within the crypto sphere and understand how it differs from traditional markets like the stock market. In the stock market, we often see a high correlation between stocks, especially during significant downturns impacting major companies or when large-scale economic events send ripples across the entire market. However, the extent of this correlation and the strategies for risk management can differ significantly when compared to the crypto market. Let's break it down. Correlations in the stock market. High correlation. During economic downturns or major financial events, most stocks, even across different sectors, tend to move in sync, generally downwards. Remember the 2008 financial crisis? That's a prime example of this correlation in action. Almost all stocks, regardless of their sector, experienced a sharp decline. Risk reduction through diversification. Despite this high short-term correlation, stocks from different sectors tend to show less correlation over the long term. This is where diversification proves its worth in the stock market. For instance, by diversifying your investments across technology, healthcare, and consumer goods stocks, you mitigate risk as these sectors are unlikely to be affected uniformly by economic factors. The takeaway? The stock market exhibits high short-term correlation, but offers effective risk reduction through diversification in the long run. Diversification acts as a shield, safeguarding your portfolio from the dramatic swings of any single sector. Now, let's switch gears to correlations in the crypto market. Even higher correlation. The cryptocurrency market often displays an even tighter correlation than the stock market, largely due to the dominant influence of Bitcoin. When Bitcoin experiences a price dip, most altcoins follow suit. Any negative news surrounding Bitcoin tends to send shockwaves throughout the entire crypto ecosystem. Limited risk reduction through diversification. While diversification within the crypto market can amplify potential returns, it doesn't offer the same level of risk reduction as seen in the stock market. This is mainly due to the strong correlation and reliance on Bitcoin. Even with a diversified portfolio, a significant Bitcoin downturn often drags down altcoins, often even more sharply. In essence, diversification in the crypto world is primarily a tool for maximizing returns rather than a guarantee for risk reduction. So how do we navigate this unique landscape and diversify effectively? 1. Strike a balance. Bitcoin and altcoins. Bitcoin, often dubbed digital gold, stands as the most stable pillar in the crypto world. Maintaining a portion of your investment in Bitcoin is like having a safety net. It provides liquidity, stability, and generally lower volatility compared to many altcoins. This Bitcoin allocation helps to cushion your portfolio against the market's wild swings. Many newcomers enter the crypto arena with an attack-heavy strategy, eager to go all in on the latest promising altcoins while overlooking the importance of a solid defense. They load up on high-growth, high-risk altcoins, often neglecting Bitcoin, viewing it as a slow and steady player in a fast-paced game. However, they forget that when the market tides turn, Bitcoin often acts as the strongest defense against the storm. Remember, you can't win a battle, let alone a war, with a purely offensive approach. You need a strong defense to weather the inevitable storms and emerge stronger. For instance, if you have $10,000 to invest, allocating $5,000 to Bitcoin ensures that a significant portion of your capital is anchored to Bitcoin's relative stability and liquidity. During market fluctuations, Bitcoin's value is more likely to hold steady or experience less volatility compared to many other altcoins. 2. Explore altcoins with potential. The remaining portion of your capital can be strategically channeled into altcoins that show strong potential. Altcoins often present opportunities for more aggressive growth, but they also come with their own set of risks. When choosing altcoins, focus on projects with strong fundamentals, a dedicated development team, real-world applications, and the potential to disrupt or innovate within their respective sectors. If you're feeling overwhelmed by the sheer number of altcoins, or if extensive research isn't your cup of tea, consider investing in the top 10 or top 20 cryptocurrencies by market capitalization. You can allocate your capital proportionally to the market cap of each coin. This approach allows you to ride the overall market wave. When the market rises, your portfolio is likely to rise with it. Imagine a rising tide lifting all boats. That's the power of aligning your investments with the broader market trend. 3. Due diligence is key. Every coin comes with its own set of risks and potential rewards. Thoroughly research each project before investing. This includes delving into its white paper, understanding the team behind it, analyzing its real-world applications, and gauging its potential for growth. Steer clear of investing a significant portion of your capital into low-cap or micro-cap coins. These coins, while potentially lucrative, come with substantially higher risks compared to their more established counterparts. Strive for a balance between risk and potential reward, and never invest more than you can afford to lose. 4. Rebalance regularly. The cryptocurrency market is like a constantly shifting landscape. Just as you wouldn't drive a car for years without ever checking the engine or tire pressure, your crypto portfolio needs regular tune-ups. This means periodically adjusting your asset allocation based on market performance and the shifting dominance of individual coins. Consider rebalancing your portfolio quarterly. This involves selling a portion of your holdings in assets that have experienced significant gains and reinvesting those profits into assets that haven't performed as well or present a more attractive risk-reward profile. This practice helps to manage risk and ensures your portfolio aligns with your investment goals. Now, let's shed light on some common pitfalls to avoid when diversifying your crypto portfolio. 1. Putting all your eggs in the altcoin basket. One of the biggest mistakes, especially among new investors, is diving headfirst into a single altcoin without the safety net of Bitcoin. When your entire investment hinges on the fate of one altcoin, the risk multiplies. Altcoins, known for their price volatility, can experience dramatic swings, and some might even fade away from the market entirely. Remember, diversification is about spreading risk. Relying solely on an altcoin, especially without a foundational Bitcoin allocation, is like building a house on shaky ground. 2. Over-diversification. While diversifying across multiple cryptocurrencies can broaden your opportunities compared to investing in just one, there's a point where excessive diversification can be counterproductive. Beyond a certain threshold, think 20 coins, adding more cryptocurrencies to your portfolio might not significantly reduce risk. In fact, it can dilute your potential returns as the capital is spread too thin. Managing a highly diversified portfolio also requires more time and effort. You'll need to track the performance of each asset, stay updated on news and developments related to each project, and make timely decisions about rebalancing. Sometimes less is more. Neglecting security. With multiple cryptocurrencies in your portfolio, transferring all of them to cold storage for maximum security can seem like a tedious task. This leads many to opt for the convenience of leaving their assets on exchanges. However, storing your crypto on an exchange exposes you to the risk of hacks, security breaches, and potential loss of funds. Think of it this way. Would you leave all your cash in a public park just because it's convenient? Your crypto assets deserve the same level of security as your traditional finances. Explore reputable hardware wallets or other secure offline storage solutions to protect your investments. 4. Ignoring portfolio rebalancing. Over time, the crypto market landscape changes. The once promising altcoin you invested in might lose its momentum, while another might emerge as a rising star. Ignoring the need for periodic portfolio rebalancing is like neglecting to adjust your sails as the wind changes direction. You might end up drifting further away from your destination. Regularly review your portfolio's performance and ensure your asset allocation aligns with your risk tolerance and investment goals. This might involve selling a portion of your holdings in assets that have significantly appreciated and reinvesting those profits into assets with better growth potential or a more favorable risk-reward profile. Diversification in the crypto market is not about completely eliminating risk. That's an illusion. It's about strategically managing risk while positioning yourself to benefit from the immense growth potential of this evolving asset class. By embracing a balanced and informed approach, continuously learning, and adapting to the market's ever-changing dynamics, you can navigate the exciting world of crypto with greater confidence and set yourself on a path toward achieving your financial goals. And that wraps up today's episode on diversification in the crypto space. Remember, investing, especially in volatile markets like crypto, involves risks. Always do your own research, invest responsibly, and never invest more than you can afford to lose. If you found this episode insightful, don't forget to hit the like button and subscribe to our channel for more empowering content on personal finance, financial freedom, and navigating the world of investments. Until next time, keep learning, keep growing, and keep striving for your financial best.